If you have extra money, is it smarter to use it to pay off your mortgage or to invest? That's today's big question, so let's get started.
Hello, everybody, and thank you for joining us on the Financial Pathway Podcast with Nate Skelly, where we discuss important financial questions and give you practical advice to guide you on your financial journey. If you enjoy the podcast, consider subscribing and leaving us a review. You can also follow the Financial Pathway page on Facebook for more helpful financial tips and videos.
All right, welcome everybody. Thank you so much for joining me today. I hope you are enjoying your summer. School is out, or at least it is for most schools. And so maybe you're already on summer vacation and that's where you're listening to this episode. Maybe your vacation is going to be later this summer, but either way, I hope you'll have some time to be able to detach and recharge over the next few months. Could I ask you for a quick favor? I really appreciate everybody who listens to the podcast regularly. This will take 1 minute of your time, but if you have not already, could you please give us a star rating, a 5-star rating, and a review on the Apple Podcast app? And then if you are on YouTube, would you go over there and subscribe to the Financial Pathway YouTube page as well? That would really help us out. If you feel like you've been benefited from the podcast and from the content that we share here, that would just help me to be able to get that same content out to more people. And I would really appreciate you just taking 1 minute to do that. And thank you so much for that. Well, today's question is a really good one. And as is the case with most of the questions we try to answer on the podcast, it's not a simple binary answer where this is right and this is wrong. Of course, if it was as simple as always pay off your mortgage or always invest, then it wouldn't really justify doing a whole podcast episode to answer it. So we're going to dig into the question. We're going to talk about the times where one answer may be more beneficial than the other. Before I do, there are really two scenarios that would even prompt this to be a question in your mind. It could be, number one, that you've got a lump sum of money that you are considering what's the best way to use it, what's the best return on my investment, or it could be an increased cash flow. So maybe there's a new job or a second job, some reason that there's more income, more inflow now, so therefore there's higher capacity to be able to do more on a monthly basis. So is it better to pay more off on my mortgage and get it paid off quicker, or should I take extra money and invest it for retirement or for a future goal? Or should I do a combination of the two? So in either case, the benefits and the drawbacks are going to be similar. Whether you're looking at a lump sum situation or an increased cash flow situation, whether you're looking to just make a one-time decision or something that's going to be an ongoing monthly type of decision, I'll tell you right now, the answer is going to be different for different people. Some people should absolutely go ahead and pay off their mortgage. And there are others that I would advise to not pay off their mortgage because I think they'd actually receive a greater benefit by investing the money instead. Now, two important considerations before we even want to look at which of those two is better. First, I'm assuming here that you don't have higher interest debt out there. So if you've got a credit card, personal loan, anything that's in the high single digits or higher interest rate, then you need to tackle that first. It does not make sense to be paying extra on your house, on your mortgage, if you've got a credit card with 20% interest or a personal loan with 11% interest. So I'm assuming that those are out of the picture, that those have already been taken care of, and the mortgage is really the only debt that is still out there in existence. And then the second consideration would be, can you refinance? Because refinancing a lot of times will accomplish the savings that you wanted by paying down your mortgage in the first place. So you can either refinance down to a shorter term, so maybe you take a 30-year mortgage, cut it down to a 15-year mortgage, save a lot of years off the mortgage and interest that's going to be paid over that time frame, or down to a lower interest rate, maybe going from a 4% interest rate down to a 2.75%, or both, cutting down the term and the interest rate. So those could possibly achieve the savings and interest that you're looking for. If you haven't looked into refinancing, right now would be a great time to do that. Interest rates are historically low. They are still historically low, and they have been for a little while now. So definitely look into refinancing. If you're not sure if it makes sense to refinance, you can go back to episode 22 the Ask Me Anything Part 2 episode, go to minute 14, and you can listen to my answer there. It's about a 3 or 4 minute segment on when's a good time to refinance your house, when is it actually worth it. So assuming those two things have already been addressed, assuming you don't have any other higher interest debt out there, and assuming you have looked into the refinance option, then let's consider the benefits, first of all, of paying off your house early. So let's say you do go for paying down the mortgage. Well, what benefit is there? Well, number one, there's going to be an increased cash flow. Let's say you have a lump sum and you can afford to just, boom, take care of the mortgage in its entirety. You have no mortgage. Well, that's going to free up a lot of your monthly cash flow. Think about what you could do with an extra $1,000, $1,500, $2,000 that was going to your mortgage each month. I mean, that could make a huge difference in your month-to-month inflow and outflow. Now, remember, you're still going to have to pay for taxes and insurance. Those won't go away. If you have an HOA, those types of things, those stay in place. But the principal and interest that was going to the loan, that's what gets freed up. So if your payment right now includes all of those things, remember that not the entire payment is going away, but what was going to the principal and interest would. Number two, it does allow you to have a smaller standard of living. So maybe for some people, the goal is not really to increase their standard of living, to be able to jump up and say, now I can spend money on A, B, and C. Instead, it was, I want to really kind of shrink my needs and what I need to actually live on, and that really helps you to do that. Now, instead of maybe it taking $4,000 a month to meet your needs, now you can do it on $3,400. So that could be a benefit. Another benefit is that you now have more equity in your property. So your home is still an asset on the balance sheet. You can always access that equity by, number one, selling the property. You can sell it and get the value that way. Or you can take out another mortgage or a HELOC, home equity line of credit, though you probably wouldn't want to in most cases, especially since you just paid off your mortgage, but you still do have equity and there's still ways to access that equity. And then lastly, and maybe most importantly, is a peace of mind. And I think for a lot of people, this is why they may gravitate towards this, because there is sort of a relieving of a burden. There's a sigh of relief that you can breathe when you have no debt. There is no payment on the house. There is no debt of any kind. It's a sense of liberation, accomplishment, to be debt-free, at least mortgage-free, and many people rest easier knowing they have no liabilities whatsoever. So that's hard to put a price tag on. It's valuable, but its value does differ from person to person. Now, it's not all pros, obviously, so what are some of the downsides of paying off your house early? Well, number one, you have to consider the opportunity cost. Opportunity cost is taking into account what is the best alternative for the money that you passed up on in order to pay off the house. So yes, you derived a benefit by paying off your mortgage early, but what could you have used that money for that may have been even better? And that could be, of course, investing in your business. That could be buying a rental property. That could be investing in the market. That could have been paying off a higher interest debt, these types of things. So yes, this is good, but the question really is, the cost question is, was there something better that the money could have been used for? Now, there's a good chance that your money could have had a better return if allocated elsewhere if you're investing for a long time. So a big question we have to ask here is, what is your time frame? What's your time frame towards your goals that you're saving for, whether it's retirement or something else? If you have a shorter time frame, that means there's more volatility in the market. Paying off the mortgage means that's a safer use of the money. So, what you're going to get by paying off your mortgage in 5 years, that's a pretty fixed cost. You can calculate that pretty simply because you have your interest rate and you know what you would have paid over 5 years' time. Whereas if you invest your money in the market for 5 years, historically, what the market's done in 5-year increments is, there's a lot of possibilities. The span, the spectrum of what can happen within 5 years in the market is pretty wide. But the longer time frame, so if you're looking at a shorter time frame, paying off the mortgage seems to be the safer alternative. But a longer time frame, the likelihood of a better return being invested in the market is better and better. When you look at how the market has performed over 20 and 30-year increments, that picture looks a lot more favorable to investing in the market. So time frame is a big one here. Now, another drawback of paying off your mortgage, opting to pay off your mortgage, is that you lose access to your money. It's illiquid. Yes, you have equity in your house, but it's tied up in the house. If there's an emergency, if you need to write a check, you can't get to that money very easily. You need to either sell the house, and that can be a really stressful situation to feel like you've got to sell your home in order to access money for a need, or you're going to have to take out another loan. Like we said, either another mortgage or a home equity line of credit. If you need the money fast, this could be very problematic. And then also the time cost. So consider this. It is possible to build wealth by purchasing a home and allowing it to appreciate over time. If you bought a house 40 years ago, almost certainly it's worth more today than it was back then. And in a lot of cases, it's worth significantly more. So that's a way to build wealth by buying the house, you pay off the mortgage, and then boom, the house becomes more and more valuable over time. But it usually takes a long time for that to happen. And when it comes to investing and building wealth, time is your biggest asset. Time, principal, and rate of return. Time is the most important thing here. Of those three, they're all important. By opting to take extra money and put it on your home instead of investing for retirement or for future goals that are long-term goals, you're cutting down on the amount of time that your investments have to grow. That can make a huge difference. So the rule of 72, we've talked about it before on the podcast. You take your rate of return divided by 72, and that will tell you roughly how many years it takes for your money to double. And really, to take a relatively small amount of money and turn it into a large sum of money by the time you retire is allowing that money to double several times over a long period of time. And so that's why even a little bit of money can turn into a lot of money when you get time on your side. So just a quick a hypothetical. Let's say you have somebody, they have a $100,000 lump sum. And what their plan is they're going to take $200 a month and put it in an IRA to save for retirement. And they're doing that aside from the $100,000. But they want to decide, what should I do with the $100,000? I'm going to do $200 a month in an IRA regardless. Should I take $100,000? Should I put it and invest it for retirement now? Or should I pay off my mortgage, which in this hypothetical situation happens to also be $100,000, and they have 30 years left on the mortgage. Okay, so we're making it simple on the math front here. But in this hypothetical situation, if you decided to, and by the way, we're going to invest for 30 years, the same period of time that it would take to pay off the mortgage, 30 years, and we're going to assume an 8% return in the market, which again, historically speaking, I think is a very fair assumption. So in option one, where this person opts to take the $100,000 and invest it all right away. Take the $100,000, boom, invest it in the market for retirement at an 8% return, also doing $200 a month on top of that. They would arrive at just shy of $1.4 million after 30 years' time. So pretty good. Starting with $100,000, then doing $200 a month for 30 years, just shy of 1.4. If, however, they opted to pay off the mortgage, take the $100,000, pay off the mortgage, and then take what they saved. And in this scenario, I'm assuming that the monthly savings that they would have freed up by paying off their mortgage is $650. The principal and interest that was going to pay off the loan, they've saved that, and now they can do $200 a month plus another $650 a month because they have no mortgage, and they can put all of that towards retirement and do $850 a month. In that scenario, for 30 years at 8%, they end up with $1.275 million. So it's a difference of about $120,000 less by paying off the mortgage. So that's an example of the time cost for paying off your mortgage instead of getting time on your side for investing for the long term. So if you want to look at it on a percentage return basis, then you can think of it this way. To immediately pay off a 30-year mortgage that is at a 3.25% interest rate is effectively a return of 3.25% a year over the next 30 years. All right, that's essentially what you're doing. That's your rate of return on that investment. Compare that to investing that same amount in the market for the same time period of 30% with a return of 6 to 7%. Now, I think that's a very safe assumption based on historical returns. Can we guarantee that? No, of course not. But again, we're trying to operate off of what we know and what we've seen and what history and evidence points us to. So And by the way, you're not going to be paying off a new mortgage either. I mean, in that scenario, I'm saying you got a 30-year mortgage and then boom, month one, you just paid it all off. Nobody does that. So in reality, most people are looking at paying off their mortgage when they have maybe 5 or 10 or 15 years still left on it, which means their actual effective interest rate is going to be even less than their stated interest rate. Because your loan is amortized over time, you actually pay much more in interest at the beginning than at the end. So like look at your mortgage payment. If you haven't realized this before, if you've not been told this before, look at your mortgage payment statements. Look at the amortization schedule. Notice how each month more is applied to the principal and less is applied to the interest. Early on in your mortgage, a lot of your payment is going just to interest. Very little is actually going to paying down the principal amount. And then that flips over time so that by the end, by the time you get to just having a few years left on the mortgage, only a little bit of the payment is actually going to interest. And most of it's going to principal. So the actual amount of interest that you're saving towards the end of the loan is way less than what the stated interest rate is on the loan. So if it says the interest rate is, say, like for instance, if the interest rate is 3.25% on your loan, by the time that you have 10 years left on your loan and you just paid it off, the effective interest rate that you saved was actually about 2%. So just keep that in mind when you're comparing, kind of making an apples to apples comparison. So if you decide to pay off your mortgage early, if you opt for that route, a couple things to keep in mind. First of all, make sure that the extra monthly payments are being applied to the principal. This may sound like a given, but you never know, and you want to make sure that your mortgage company is actually taking the extra that you're paying above your minimum required payment, and they're actually putting it towards principal and not splitting that up between interest and principal. That's going to help pay it off quicker. Also, find out if there are prepayment penalties. I know this kind of sounds surprising, but in some cases, mortgage companies are going to charge you money to pay off your mortgage early. And so just be aware, kind of read the fine print there, or just contact your mortgage company to find out if that's the case. Now, as I said before, remember, paying off your mortgage doesn't mean there's no more cost associated with owning your house. Far from it. You're still going to have taxes. That's always going to be there. You're going to have to pay for insurance, HOA fees, maintenance, repairs, etc. So you're still going to be spending a significant amount of money each year on your home. It's just that usually the biggest cost is what you're paying in the mortgage. Make sure that you have an emergency fund. Again, this is one of those things that we've talked about before, but I'm just reiterating it, that especially if you've got a lump sum of money, and let's say you got $50,000, like, what do I need to do with this? If you don't have an emergency fund, at least 3 to 6 months of living expenses, you need to take a chunk and put that aside for that. And then with what's left over, then you can think about paying off mortgage or investing. Also, make sure your employment situation is stable, because that can really complicate things. It would be a real shame to take a huge chunk of money, put it down on the mortgage, not pay it all off, so you still have your mortgage payment, and then all of a sudden an employment situation changes, and there's a layoff, or there's a move, and then all of a sudden you're kind of in a fix because the money that would have really helped you bridge the gap to whatever's next for you, you put it all in the house. And then also, as we said before, make sure you paid off your other high interest debt. Leave your mortgage for last, because it's almost always going to be your lowest interest debt. Now, if you opt to invest, if you decide to say, no, I'm not going to pay down my mortgage, instead I'm going to invest in the market, try to go long-term, get time on my side, make sure you have a reasonable expectation of the return you will get. Buying another property to rent it out may sound like a smart decision, but make sure you're properly analyzing the property, you understand the true return. Sometimes people get a lump sum of money, or they get an increased return. They think, I know what I'm going to do. I'll go buy an investment property. I'll rent it out. I'll build equity. There's be cash flow. And it sounds really good, but they haven't actually done their homework and haven't really dug into the numbers. So make sure it can be a great investment. I think rental properties can be a phenomenal use of your money, but I've seen a lot of times people rush into it without really doing their homework. Now, if investing in the market, you need to know what long-term return you can expect from your portfolio. Also, you need to know what the normal year-to-year fluctuations are. Again, expectations are everything. If you're going to invest the money for the long term, understand that, especially if you have it all in the stock market, we've seen in the last, 70 to 80 years, we've seen really high years, around 50% in 1 year. Not normal, of course, but at the high extremes. And we've seen really bad years at 30 and almost 40% down in a year. Again, not normal, but these are the extremes, and this is within the realm of possibility. Long-term returns are far from what it may do year to year, and so you need to know that and be comfortable with that before you jump into it. Also, something we didn't really have time to really dig into in this lesson or in this episode because it can get very complicated very quickly, but consider tax benefits here, okay? If you're going to invest the money, if you're going to go in the investment route, think about what options are available to you in your 401k, all right, because that's a great place to start, or an IRA, or a health savings account. Look first of all to invest in accounts that give you tax benefits, that will give you income tax deductions, or will give you tax-free income when it comes time to withdraw in a Roth account. So utilize those to the best of your ability if those are available to you. Also, know your time frame. A lot of this does come down to time frame. Invest for the long term. If you're trying to make a decision on the best use of your money for the next 3 years, I can tell you investing, especially in the market, is not going to be the right decision. So if you're trying to generate a return in a very short time frame, you really shouldn't be looking at investing in the market. You probably should be going with the safer, more guaranteed return and paying down the mortgage. Now, which one's better? Okay, again, I can't tell you which one I think is better for you unless I really have time to understand your situation. Let me finish by giving you a couple hypothetical situations where I could pretty clearly say paying off the mortgage or investing would be the right call. So scenario number one would be, let's say we have a couple in their late 60s. They have Social Security, pension. They have several $100,000 set aside in their retirement accounts to pull income from. They have cash to pay off the remaining $75,000 in their mortgage. They have a 3.5% interest rate. They still have an emergency fund. And really their concerns are keeping their monthly expenses low because they're living on mostly a fixed income. They are uncomfortable with the volatility of the market. They have no other debt besides the mortgage. They do plan to stay in the house, and their son will probably move into the house after they pass. So this is a case in this scenario where I think paying off the mortgage would be the right decision because they free up some cash flow, puts less stress on their fixed income situation. They have more peace of mind that they're completely debt free, and they now can pass on this house to their son without a mortgage. So that would be a scenario where they would probably be better off with paying off the mortgage. Now, another scenario could be maybe, let's say it's a single woman who's in her 30s. She's received an inheritance of $75,000. And let's say she owes $150,000 on her house, and she's trying to figure out, do I put a chunk of this on the mortgage? My interest rate is about 3% right now, and I'm not maxing out my 401k at work. I haven't started an IRA before. This would be a situation where it's more likely that she should invest the money for the long term because what she can get over the next 30 years is in all likelihood going to be a better return and more beneficial to her than saving a little bit in interest over the course of her loan. Now, again, everybody's situation is different. There's more details. There's always a deeper story. So if you're in this situation, or maybe you know somebody who's trying to make this decision and they want to bounce some ideas off, they need some advice, obviously, of course, I'd be happy to be a resource in that way. But I hope this gives you at least a starting point and some parameters to begin this discussion and try to determine that question for yourself. So if you haven't seen already, I have reworked our website, the Financial Pathway website, nateskelly.com. I hope you'll go over and check that out, take a look at it. Love to hear your feedback. On there is a feature where you can go ahead and schedule a call. If you've maybe been listening to the podcast for a while, maybe this is the first episode you listened to, and you've got some questions, you're trying to think about, maybe should I work with a financial planner, or just to get some input and understand a little bit more about what it is that I do and maybe where I could help in your financial situation. there's a feature there where you can schedule a complimentary 30-minute call, and that'll just give us a chance to answer any questions that you have, to discuss how we work with clients, and just to see if that would be a possible fit for us to work together. Also on there is our blog post, which I'll be posting articles with regularity. Every month I'll upload 2 or 3 new blog articles, just trying to find more avenues, more ways to put helpful financial advice and content to help you on your financial journey on a wide range of issues: personal finances, investing, giving, and more. Thank you again for listening to this episode, and I'll see you on the next one.